On today's show, 3 questions. Number 1, will AI force us to cut interest rates? Number 2, is active management alive and well? And number 3, whoop, there it is. Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Rabih.
Yeah, you are. Just the two of us today, Rabih.
What's up?
And how are you?
I'm doing good. Post-summit recovery. It's been great.
Post-summit recovery, it honestly took me, I'm not kidding you, it took me multiple days. All day Sunday, the following day. I was exhausted. I took like a 2-hour nap that afternoon. I went to bed at like 9 o'clock that night. I was so tired. It took me a solid like 24 hours to feel when you're just on that much, when you're just like on, you're talking to clients, you're talking to partners, you're speaking, we're doing a podcast. It was like 3 straight days, and we're setting up, we're taking down. It was a lot, but what an amazing event. It was so much fun.
It was so much fun. I think what kept me going through the last 3 days was like the vibe and the people and engaging. Once those, went home, I just crashed in my position. So
honestly. Oh, it's so true. The second that last night, some of us were going to get together after, like hang out and play games. And I went and laid down for like 5 minutes and I was like, nope, I am done for. I am done. So it was so fun though. There's something about those, like as a team, there's something about like coming together and like just like up at 6:30, go until 9, like just like all out for a couple of days to put on this event. There's something about that I feel like just makes you feel more connected. I don't know. I loved it. I love those kind of things. So
it's called trauma bonding.
It's got. I think you're right. We were trauma bonding together. It's such a good point. But I love it. It's become like our holiday. It's like a DA holiday for us. So doing it again next year. We already have it planned we're changing the venue this time. So wait for details on that. I'm sure you're going to be hearing my ridiculous calls to action. Not yet. We're not going to do them yet. We're going to get people to rest, but including myself. But we do have some details coming up of where it's going to be and all that. So June of next year will be fun. All right, let's jump in. Number 1, will AI force us to cut interest rates? This intrigues me. What are we talking about here, Rabih?
What comes to your mind? What comes to mind when you read that question?
I mean, the first thing I think is AI going to create efficiencies in companies to the point of like making inflation worse? Like, is it going to be an inflationary force that's going to force that's the first thing I thought of. I have no idea what your topic is about.
Okay.
But that's the first thing my brain went to.
I love it. Okay, good. My topic is actually about unemployment, and it is related to AI. So I pulled up some data, and we have the unemployment rates for recent college graduates versus other groups in the economy, and we are starting to see the impact of AI happening. So most of the news lately has been that companies are slashing their workforce, and they are replacing them with AI tools. I've seen it on S&P 500 companies, other private companies that we've been reading research on. It is happening elsewhere. The amount of entry-level jobs is actually diminishing, especially in jobs that are easily replaceable by AI. And we have had enough time of this happening that now we have data. So actually what we have is the unemployment rate for recent college graduates aged 22 till 27, all college graduates, young workers aged 22 to 27, so it includes people with college degrees and not, and then all workers. Back in July 2023, just to give you some reference, unemployment for all workers was 3.5. That was the lowest it's ever been, and now it's at the 4.2 level, right? So it has increased. What has happened to those other subcategories? So young workers in general, everyone, unemployment rate back in July was 6.3%. Now it's 6.9%. So it increased by 0.6%. For all college graduates, the unemployment rate was 2.2%, increased to 2.7, so 0.5. As you've seen, there is a similar trend to the broader overall unemployment is just increasing by 0.5, 0.6, etc. However, if you look at recent college graduates aged 22 to 27, the unemployment rate was 4.2% in July 2023 and has jumped all the way to 5.8% now in May 2025. And this is more than double the level of unemployment we are seeing in, the other portions of the labor force. And this is fascinating because right now it's probably one of the hardest markets for recent graduates to find a job, especially if they are in jobs that are, coding, administrative jobs, stuff that could be easily automated through AI that we are seeing through these large language models. So this is fascinating because this means that, we're not still waiting to see the impact of AI. It is already happening. We are already experiencing it. So the question would be, what does this do? Now we are seeing unemployment. Unemployment usually means that the economy is slowing down and would force the Federal Reserve to go and cut interest rates. Will now AI, just because it's blocking people out or boxing people out from getting new jobs, slow down the economy? And it's a really interesting conversation about that productivity gain that you just mentioned and the impact of technology on the economy. By the way, just to like ruin the surprise really quick, I don't think so it will be that immediate yet, simply because the those recent graduates, age 22 till 27, are around 7.2 million workers, and that is around only 4.2% of the US total labor force, out of the 170 million that are employed in the US. So it's only 7 million out of those that are struggling to find a job, and their unemployment rate has jumped all the way to 5.8%, right? So they are still a small portion, but if there's, something that's starting to roll
A
downhill like a
trend,
rock,
yeah.
this is where we are seeing it start to happen. It is easier to not hire than to fire, right? So this is how it is advancing. We will see in the couple of months of how it works. But it is interesting because this type of productivity gain is completely different than how we usually have it. So let's talk about just economic productivity in general. Let's think of a dental practice. If for some reason now you have a new technology and you are able to have 20% more procedures in a day than you usually had with patients coming in and out of your dental practice, right? This means that the cost per procedure has kind of dropped by 20% just because you can. So technological advancement, whether it's a new technology, new skill set, etc., lowers costs overall. And lowering costs means higher productivity. When you are lowering costs, you have more money. In usual technological advancements, what happens is that now employees are able to produce more with the same amount of resources. So the company makes money, and because they have become more productive, they usually go out and ask for raises. That's how the demand cycle happens. And then that productivity surge and income surge will be distributed on the owner of the business as well as the employees, and it allows money to revolve and rotate throughout the economy as a whole. However, this technology is decreasing costs, right? We are becoming more productive. But now, instead of going back to the dental practice example, instead of you're able to produce more, the dental practice is doing better. So because the business is doing well, you're going to give more for your office manager, assistants, etc. In this scenario, you're able to produce more, but you are not hiring an office manager, and those people are not getting the money, and that kind of puts a block in the flow of the circle, right? Usually productivity gain means that real growth in income for everyone, and because of that, everyone is able to spend and grow the economy even further, and it spirals into growth. And this situation, productivity in terms of AI, is preventing everyone from getting the benefit because some people will not be employed out of it or will have a hard time getting employed. What this would mean is that those people would not have the money to spend to stimulate the economy. So, in the traditional example where it does not affect unemployment, productivity gain does not affect unemployment, it usually spirals into more growth. But in this situation where productivity gain might affect unemployment, does this mean that we will have a slump? And before those people decide to relocate and change their task skills, would that mean that we would have to cut interest rate to stimulate the economy again? It is very interesting. It is a technological advancement, but it is unique in a sense that its impact on job loss or the ability to find a job to start with is more pronounced than it usually was, more than cars, more than electricity, more than everything, because we moved to a more service oriented economy that is digital, and a lot of that could be automated.
Yeah, it's so interesting, Robbie. There's so many questions here that so above my pay grade to even know where this goes, and this is a whole other conversation. But I guess a couple of things. Number one, I do have so much empathy for young people now who are coming out of college in such a different landscape than maybe we've ever seen. To your point, there is a level of uniqueness about this innovation that you just highlighted perfectly that I think has people nervous of like, what does this actually mean for the long term for the workforce? My default is that like we'll adapt like we have to everything else as a society, and I think we will. The question is, what do we do in the interim, the gap of that kind of adaptation, like the required adaptation that's going to require, number one, how long does that take, and then two, what happens in the interim? Because we're talking massive societal shifts, economic shifts, right? We're talking complete, like there's so many factors here that we don't even know, again, how long it's going to take and what we do. So these are more rhetorical questions that are going through my mind of like, just what do we do? Like when this conversation all started, meaning like the conversation broadly around AI, my like short-sighted brain, I'm sure, like my very limited brain was thinking, well, we've seen like massive innovation in the past. Like you think of what you think of the turn of the from the 18th to 19th century or the 20th century, like the different technologies we have. So just think of like the airplane, like what that did to, let's say, the railroad industry, which is like the backbone of our economy for so long. That's an example of just thinking we adapted, we figured it out. But as you're highlighting, something about this feels different.
It doesn't feel a bit different as much as it's grandeur. It's large. Like a very similar analogy would be, remember how like tech bubble happened and '08 happened, and there was real economic meaningful impact in '08 that changed the economy. Like pre '08 economy is completely different than post '08. And we said, oh, the millennials are facing a once in a generation type of thing where, and we keep repeating those sentences, oh, they're going to be poorer than their parents type of, until, and it took long, it took like 12, 14 years until we went back on track, right? So the issue with the labor market for fresh graduates is going to go into this regime of free adjustments that might going to be taking time. Also, in the report that I had, 40% of software developing jobs on Indeed have been reduced. 40% of them disappeared. 40 drop since 2023 in the amount of postings related to these jobs, right? It is a lot. And on top of that, I don't think current curriculums are adjusted for what the current workforce needs, right? Like if you just graduated, you are still working with non-AI related data. You are still going there doing the stuff that AI can do much better and faster than you. So it'll take time for adjusting. And unfortunately, for that bunch of cohorts that are in that time, it might mean slower entry into the economic cycle. They're going to be behind on their saving just because they didn't have the money to start saving. Those are the type of implications. But hopefully, on the long run, on average, disregarding the specific cohort, our lives are going to become better. Productivity, in a sense, is deflationary. And this is very interesting because the conversation with the Federal Reserve right now is still, oh, we need to calm down, wait, just because we are afraid of the impact of tariffs increasing inflation. We got an inflation reading this morning at 2.7, which was higher than expected. All of that is happening. But all of these, I would call them short to medium term inflationary pressures. But we have a long term, larger scale deflationary pressure in the form of technology. And when I mean deflationary, just think of your iPhone. It's this easiest, simplest example, right? Every single year, it might be probably 50 to $100 more expensive, but the amount of technology in it is increasing from one year to another. I'm not talking about the new camera. I'm talking about the processing power, the ability to, crunch more numbers, do more
Activity of it, actually. Yeah.
Yeah, that value way exceeds $100. So the value, not the price, the value out of an iPhone has been increasing over time, which means it is deflationary. You're getting more for the same amount of money. This is what technology does. And usually that is very beneficial. But if that's going to put people out of jobs and create this systematic dysfunction for a short period of time, it might mean that we're going to follow a J. Like if you're trying to write the letter J starting from left to right, you'll have to dip a little bit before you go way up.
Yeah. Well, the other thing that's worth highlighting is what you said there, Rabih, that both things can be true, that it can be better for overall for our society and economy, right? While also having a massive impact at personal levels of certain cohorts of people, which is what we're seeing, which probably, I think, probably plays a huge role just fundamentally in what we're seeing today and how divisive we are. There's a lot of factors for that, reasons for that. But I think maybe one of the reasons why we've talked about on the show before of like a narrative mismatch of like, wait, the numbers don't support this. Like the numbers don't support the narrative of like things going poorly. But I think part of it is, as you say this, it's probably because of this fact that the overall broad numbers can look good. And then again, certain factions of our society are getting kind of screwed right now. Like I think young people coming out of college are kind of getting screwed. It's just poor timing. It's just like, and they'll be fine. Like we will be fine as a society. We will adapt. I think the biggest fear right now is just the unknown. So anything else you want to add to this AI, unemployment, any other impacts that you want to highlight there?
No, the stock market seems to be very bullish on the AI story.
Yeah.
Nvidia just broke its all-time high again, forcing the S&P to break its all-time high. We are doubling down. I think the train is already in second gear. Like we are heading to that direction, and
Yeah.
our lives are changing because of it. And let's see where we end up.
One of the other questions I have, and again, this is a broader, bigger topic for a different show, but you do wonder, Rabih, just as you say that, is does this continue to create this what we know is there, which is a massive wealth gap? Like, is this a force that that continues to widen the wealth gap? That's probably something that's a pretty big worry, I think, if we're talking just macro. Like, does this create more of the haves and more of the have-nots?
Yeah, in a capitalist economy that we are in, the dispersion between producing members of society and non-producing members of society, or capitalist versus non-capitalist, we could all be capitalists. We could just interact with the stock market. A feature, not a bug in the system, is that it creates those gaps and it separates the performers from the outperformers. So yes, technology and creation of value and selling products and everything that we do that grows business is gonna put some people ahead of the others. The capitalist forces do not define the society we want to live in. We could strike a balance between growth for everyone and equity for everyone.
Yeah, yeah. We'll end on a positive note here on this segment, so we're not all doomsdayer. And you tell me, Rabih, if I'm thinking about this the wrong way, but I think the best analogy here or parallel would be the late 90s, kind of the turn of the 21st century, which was the creation of the internet. And again, I think this is probably on a much larger scale, even compared to that. But the parallel I'd want to highlight here is the internet upended a lot of industries, and I think put a lot of businesses out of business, right? So a great example of this is what Netflix did to Blockbuster, right? This is a really, really well-known example of what Netflix did to Blockbuster, and the mismanagement of Blockbuster, that's a whole other story. But I want to highlight that it can also be true that a massive piece of technology that it completely changes our industry and our economy and our world will put a lot of people out of business. I think also on the net, think about, we don't even know yet the opportunities it's also creating for individuals and new businesses. So I want to highlight that as like, still say on the net, long term, there's probably more opportunity created from innovation and technology like the internet, like AI, like all these things that are happening, even if in the short term it is kind of creating some fear and anxiety and some negative impact. What would you say to that?
100%. No, I agree. Like we're moving from Blockbuster, Kodak, manual cameras, having an alarm clock by your by your bed type of lifestyle to the lifestyle that we live now. And because of this new lifestyle, we have more jobs. I would say 85 to 90% of all this change is positive. The only time it is not positive if you are an individual located in a position where it affects your traditional. And in that sense, it's very easy. I maybe should be careful here. It's not easy for everyone, but the way out of it is to revamp and acquire new skills. And that, in that sense, as an individual, you immune yourself from the changes and you follow the stream, you follow the momentum of the new technological advancement. Also, that is from an individual. From an investor, make sure that you are not just in those companies that are going to be left behind. Diversification is the easiest answer. We say it repeatedly on the show. but just make sure, like, even there are researches. Now, just recently, Gemini from Google has been making advancements. But for a couple of months ago, we were saying, oh, the Google search engine is going to disappear. And now Google search is going to be, BlackBerry. It is still useful and there, but new technologies are doing stuff that are much better.
Yeah.
The conversation, the fight isn't over between whether Google search is going to disappear or not, but it is on the table. And 2-3 years ago, who would have thought that we are thinking about replacing Google search engine to start with?
Yeah. It is a wild thought. And that's a great point there of just the Google, what it has been in our society for multiple decades. And now we're talking about it being replaced. So again, another shout out to diversification. Okay. Speaking of, you mentioned all-time highs. We'll just do a little S&P watch. Rabih, we know Jake and I called it out beginning of this year as things were getting a little rough where we're at. I'm shocked by this. So we did hit all-time highs today, as you mentioned. You have data, probably not in front of you, but we've talked about data before of like all-time highs or group with all-time highs. So once you hit that all-time high, it's actually a bullish sign usually.
Yes.
But where we're at with the S&P year to date, we are up over 5%, nearing 5.5% for the year. Just this week, we're up 3.5%.
Yes.
Big week. Anything you want to mention on that just before we get into the next topics?
Well, we started the week by very quickly entering and then ending a war, right? And then today we got data on...
Are we calling that a war? Is that what we're going to call that?
I do not know. It's an operation.
A skirmish? Yeah.
And then today, this morning, that was also a contributing factor. The US has signed a larger part of the deal with China. Of course, there are still question marks, but the details of the trade deal that they agreed on in London a couple of weeks ago has been released today, and the market seems to really like it. We're going to cover it in future episodes, just was released an hour ago. But those have been all bullish signs for the market, as well as company-specific data. Also, just to add to your watch, we've got emerging markets up 15% year to date, developed markets up 20% year to date, and then a globally diversified portfolio is up 10% year to date. Good stuff.
It's good stuff. Yeah. Well, it's all good right now. This is, again, we keep saying, are we calling the top? We don't know. Every time I gloat on this show about the positive S&P, I'm always a little worried I'm jinxing it. But all right, well, speaking of, let's jump into the next topic. Is active management alive and well? There's no data here. This is actually just like a personal experience. I was in Chicago this week, went out to the Morningstar Investment Conference for a couple of days just to go walk around, check it out, to see if it's something we want to kind of do in the future. But it was so interesting, Rabih, and I was sharing this with you before we jumped on. I sat in on a couple of panels and listened to the CIO of BlackRock. And yes, the whole time I was sitting here being like, Rabih should be here with me. But it was so, and I walk around all these booths. There's so many people. I can't even tell you how many companies are there. And majority of them are active managers. A majority of them are sitting there telling you that they know how to time or how to beat the market, if you will. And one of the panels specifically that I thought was so eye-opening was 3 different fund managers from 3 different companies. One, Luma Sales, Fidelity, and then another one I can't remember. And there was like an hour-long panel, and they popped up on there. They were talking about this specifically around the Mag 7. And they pulled up on the screen, and they held it up the entire time. The individual, so each of those managers and their specific funds and how much they had in each one of those specific companies. A couple of them, one in particular, had no NVIDIA, which was shocking to me. I'm like, how are you even like hanging with anybody right now? No NVIDIA, no Apple, and then one other one. And then again, all of them were different with their allocations. And it got me thinking, I'm sitting here listening to this panel and they're all giving their opinions on like this company versus this company. And number one, I thought, holy cow, like we live in a world right now of, I wouldn't even call it passive because we're not full on indexers like a DA. We've talked about this before. We believe in some active decision-making components of investing, but we kind of have this foundation of let the market do its thing, just own the market, right? But I was sitting there thinking like, holy cow, a majority of the market, a majority of the industry still believes in active management, which I shouldn't maybe be surprised by. I think we have this illusion of control, whatever. But the other thing I thought, as I've thought like afterwards is, and I want to get your thoughts on this, Rabih, is we kind of need this, right? Like this is the kind of what makes it work. Like the market only works when people like if everyone started only believing in passive investing, the market wouldn't work. Is that fair to say? Like we need these different opinions to the like I'm watching this panel, listening to these guys, and I'm like, this is what we actually need for this to function. Is the different opinions. Tell me where I'm wrong on that thought process.
We need different opinions, 100%. And that's how you make a market, because you need a buyer and a seller, right? However, it does not mean that if your philosophy is that of a passive investor, and what we mean by a passive investor is that you are not trying to outguess the market. Whatever the price is, you believe that that price is efficient. That is what passive is. Active is that, no, the price that I'm seeing in the market is not accurate, and I know what the true value of the price is. This is where they differ. So once you describe them in that sense, you change the connotation of passive as someone who's not really thinking about what's right, thinking about the market and just taking it for granted. No, a passive investor is saying Apple is down 15% year to date. Well, the market is telling me something about the Apple. That is a passive investor. You may choose to invest in Apple at that point or not. But an active investor would say, oh, Apple is down 15%. It should probably be up 23%. So I'm going to double down and do, etc. Are you arguing with the price the market is giving you or not is what determines whether you're an active or a passive. What makes markets efficient is difference of opinions. I think we get these mixed up. So the fact that we have more and more passive investors in the market, or people who are just putting money in Vanguard funds, it does not make the market inefficient. This is not true. The data doesn't show it. We've got research from the DFA that talks about it. Just the fact that this year we've got the S&P up 5%, right? And we've got companies like NVIDIA, I think up 25% for the year, but also Apple down like 15% for the year. This tells you that although a lot more and more people are just buying those, between quotations, passive funds, the market is still efficient. Because if it wasn't, all companies in the fund should be up 5%. Why do we see this difference in return between one company and another? So passive investing, in terms of how efficient the market is, the price discovery process is still there. There are concerns about passive investing in the sense that, does it affect liquidity? Because everyone's just buying the fund rather than going through the channel of doing individual stocks. It gets more complicated about how does the market react when there's panic situations. Passive investments versus active doesn't derail us from a good functioning market. This is what the research has been saying.
Yeah, that makes sense. And even let's say we were worried about that. Let's say that was a worry for a second. It shouldn't be, because there's still a lot of people. I was just at a 2-day conference where every single company there, every single person there was in some form or fashion an active manager. And again, I'm watching these panels, I'm listening to these keynotes. It's crazy. The entire industry is still built on this idea that you can time these things, or that you can pick one company over another, and that you can kind of quote unquote beat the market, when the data shows that's really, really, really hard to do.
I actually hate to go to these conferences. I've gone to a bunch, the ones I've gone to, whether they were here or in different states. And I think once you go as an investor to these conferences, you get peer pressured into the idea, oh, I'm sitting in a room where 95% of them are active managers. Am I doing anything wrong? Right? And on the contrary, they are what they are doing wrong. We could be very vocal about this. One, the data shows that over the long run, you do not outperform the market as a whole. Two, the market, and I think it's very funny that we were just talking about AI and people who are left behind. This is a faction of investment professionals who are still left behind. They can only justify the fees that they do by them telling people that I can outperform, although the data is definitely against them. Instead of them trying to re-innovate themselves in a changing market environment that is more efficient, where data is accessible to everyone, and try to provide their value through other channels, where they are sector specific, like Dentist Advisors, or whether they are looking at your financial health from a holistic perspective rather than just your return on your investment portfolio. How do you justify how to justify the fee through providing that value? The value of creating alpha isn't there anymore, but the value through more customized, holistic, fiduciary perspective on financial planning that helps a dentist get to where they want is actually a better way to provide the value. Another point I wanted to say about this is that the finance industry as itself is a very slow industry due to the regulations, due to the lack of innovation. For example, let me just give you an example. The model that was created to price options and got a Nobel Prize was created in 1975. They didn't get the Nobel Prize till 1997. And then the market didn't really start adopting it until like in the last 10 years.
Yeah.
Only in the last 10 years, we started talking about options. The 1940s Act was the legal act from Congress that protects individual investors and lays down the ground rule book. That was done in 1940s. John Vogel's first index fund, 1990s, 1980s, right? Like a couple of years later. And it's only now that we are starting to really have passive investment in the mainstream conversation. So what happens legally and sometimes what's happening academically takes like 40 to 50 years before the industry adopts it. And when you go and talk to these active managers, those are still people who did not jump on the train to what the most up-to-date research and evidence scientifically tells us about the proper way to do investments.
Such a good point, Rabih. Not to mention, on top of that, is people like, let's just be honest, the people that they're selling to believe stories more than data, right? Like
100%.
It's the most convincing story wins. I'm watching some of these people, entire like the BlackRock CIO. He did a keynote, and he's up there the entire time talking about. BlackRock's the biggest money manager in the world, right? I don't know how much they have under management, but we're talking trillions. I think it's huge. And you sit there and watch him, and he's sitting there the entire time. And I can see what you're saying, Rabih, when you go to these things. The illusion of control and all of the mental biases are in full effect when you're there at these places, where it's like you're sitting there listening to this guy go over all this data, and he's obviously super smart, and he's obviously in a really high ranking position, and he's telling you this story of like, we know how all this works, and we know better than the market, basically. And I could see how you sit there, you start to believe it. Like, yeah, of course you know better. And it's the Jason Zweig quote: people want to be lied to. They like, honestly though. So it's not only what you're saying with the regulations and the slow moving aspects of the industry. I also think there will always be a place, always, where you can show people all the data in the world, and they're still going to believe the best story. Best story wins. And there's a lot of people out there telling some really compelling stories and plugging into the human psychology of, again, we want stories. We want to be lied to. We want to know that, like, also, I think the other part of this is we don't want to be average. So when you say like, oh, just get market returns, people don't want that. And there's a huge aspect of that too.
I think that is the story to highlight. I think people are being misinformed, associating two things together. The first thing is that I want higher returns or lower returns from the market, right? I just don't want to take what it gives me. That is one. That is the first thing. And they are associating it with the personality of the person trying to generate market return. There is a completely big difference. You could be passive, quote unquote, and still generate more than market return. Come to us. We'll help you. We'll put really smart risk controlled leverage on your portfolio, and you'll do better than the market. In total return perspective, you will beat the market. It's just you're going to be taking more risk to get more return. What they are associating it with is that there is this person out there that he is going to create money that is not dependent on the market elsewhere. And this is what you hear by alpha versus beta. You want more return? We'll increase your beta or reduce your beta. We can do that. You want to go to someone there that is trying to create alpha? Where is that other value coming from? The whole economy is so interconnected. You do not walk on the street outside and find just $1,000 on the street. You don't find it in the real world. Why would you expect it to find it in the financial markets that are getting traded every single second? So I think associating these two ideas, that there is going to be that someone out there who's going to find you the $100,000 left on the ground, no one touched, versus someone who says, okay, this is the market. If you are out there wanting to be greedy in the positive sense of it, and you would want more return, then let's work with the market so you can get the higher return. Last one analogy, because I love fishing. I went fishing on Monday and fell asleep because I was so tired from the summit. This is a side note.
Like on the boat you did?
By the shore. I was like casting and my eyes were closing, so I went home. So I was so tired.
That is a mental picture right there.
But the idea is you're going out fishing. An active manager was going to tell you, hey, we're going to go in this pond or this lake. There might be no fish in it or fish in it, but I will be able to get you a shark from it, whether there is or there isn't in the water at all. Whereas a passive investor, or I wouldn't call it passive, the beta investors, rather than those alpha, than
Let's
the
call it
people
a
you see.
systematic investor, maybe.
A systematic investor is going to go say, oh, okay, we're going to go on this boat, and, everyone just uses a hook that is this big. If you want more risk, let's put more than one hook. Let's add more baits in there, just so our chances of getting higher return is there. Which one do you want to believe? The guy who got more tools at his disposal to hopefully give you a better fish because you've been asking for a bigger fish than the market, or just someone who's just gonna voodoo come up with a shark in a closed lake? This is the argument. Why are we associating these two things together?
I love everything about that analogy, from you falling asleep to talking about a shark in a lake to then saying voodoo. That's the perfect analogy. I love
You got
that.
me hyped up on
I
this
got you
subject.
going. I got you going. I love it. Okay. We're going to end it there. We're going to leave that segment there. I think that's a whole, there, we could talk about that for a long, long time. But the main takeaway, just that active management is very much alive and well. I've realized that we still have the whole industry built on.
Unfortunately.
Yeah, we're still very much alive and well. And I think we'll continue to be there because people will continue to want to be told the story that someone out there has the voodoo magic to get a shark out of a lake. Okay, last topic. This is just fun. This is nothing. We're gonna end it here. Whoop, there it is. Rabih, we both get on. We could tell the people we both get on. We both get on, and before we started recording, you got so excited, and you were like, "Hey!" And you hold up your hand and your wrist, and I did the same thing, and we both show each other our whoops. That we both got whoops. I just activated mine today. For those of you that have listened to this, maybe consistently, I know some of you are out there. You know my Fitbit debacle, and the fact that the team was giving me so much crap for that. I decided to upgrade after that broke after like 30 days, and decided to go for the whoop. But there is a money analogy here that we don't talk about for a second. I was thinking a lot about this now that I have it. I got it activated. I'm like tracking some stuff. Like the importance of having data, the importance of tracking data, and how simple, but how difficult that is to consistently track your data. But I've realized something as I have like my fitness and my health goals as I'm getting older, and a lot of my goals are actually changing like quite a bit the last like couple of years. And it's taken me, talk about moving slow, Rabih. My brain knows what I should be doing for my fitness goals, but I'm also like really hard to break certain habits and certain goals that I've had. But I was just thinking about like how critical it is for you to actually make meaningful progress in your life in any aspect. But let's talk about obviously finances without data. Like it's impossible. It's impossible to make meaningful, consistent improvements without data. And that's the epiphany that I've been having with now, like me resisting this whole idea, me thinking like, oh, I can lose weight by just like saying I want to lose weight. It's like, well, no, you actually have to be systematic about this. And I've been thinking a lot about this as we've both got our whoops now. What are your thoughts or reaction to that?
Well, if you're in a dark room, you will not know where to walk without having the flashlight on. Like this, it is as simple as that. And the light, in that sense, is the data. I used to do improv, and there was a quote that they always say: "We live life walking backwards." Right? You are walking in the same direction, but you are walking backwards. So you can only see what has happened. You do not know what will happen. And imagine that you are still walking backwards, but you do not see the steps that you have taken. The data allows you to just track where you've been. So hopefully you can draw insights. It's not only finance, it's everything. You sit and reflect on decisions you've made in your life, on remembering a good meal, conversation with a friend. All of these also have their translation in the financial world, right? Opportunities where you have saved money, or opportunities where you made the right financial decision or spent the money in a way that was very meaningful to you. And that track record is our only hope to knowing on where we're going to go forward. So without data, it is voodoo, right?
Yeah,
It is voodoo.
it's so true. I love that. And I've come around to this idea. I mean, I've known this idea for a long time, and I've kind of like this idea of like practice what you preach, right? and I'm getting better about that, at least with my health, the health side of things. But it's so true. Like if you're not tracking your data financially, health wise, business, whatever it is, A, how do you know you're ever actually making progress? And B, I think we've talked about this a lot. We talked about this on the show, this episode. I think our brain's ability to adapt is our greatest gift and our greatest curse. But I think people out there that like people question like how is someone who is like who's so much wealthier than me, right? They look at someone, they look up to someone maybe who's so much wealthier than me. Like, how are they still stressed about money? How are they still struggling with X, Y, or Z, whatever in their finances? I think a huge part of this for people, like as they start to like make progress, but they're not noticing it because they're not tracking it. I think a huge reason why you see people who are still stressed with money, even though they have made incredible progress, is because the sheer fact that they're just not tracking it. They're just not looking at how far they've come. They're not stopping to be like, holy cow, look what I've done over the last 5 years, 1 year, 10 years, whatever it is. I think there's a huge part of that. So I guess this is just my PSA as we've got our whoops, Rabih. I'm making more of a commitment on the health side to track my progress. And I think there's so many analogies and parallels to like to the impact of tracking progress. Again, it's so simple, but it's so difficult. But the simple act of tracking your progress in just certain key areas of your life is the unsexy truth, I think, of like of finding success and in your financial life.
I can't add anything to that. That was golden.
Oh my gosh, golden?
Yeah.
Not as good as you falling asleep fishing. That was awesome. Okay, Rabih, anything else you want to add to any of this?
No, usually this part is when you plug in the summit. So I don't know how you're going to end it.
I'm not plugging the summit. What I'll plug is if you want to talk to us, we love talking to dentists. We talk to dentists all over the country. Every week, we talk to multiple dentists a week who call us up, who want to chat, get questions answered, see what it's like to work with dentist advisors. We love it. We honestly love talking to dentists and just hearing your stories. So if you're out there, if you've been listening for a long time, you know you're out there. You know who you are. You've been listening for a long time and you're thinking, man, I should call them. I should just set up a time to chat. Now's the time. Dentistadvisors.com. We're super nice. We will talk to you. We will hear your story. We'll ask you questions. You can ask us questions. Advisors.com. Click on the book free consultation button, and we're happy to chat with you. So, with that, Rabih, thanks as always for being here. Everyone, thank you so much for listening. That was our 2 cents. Till next time. Bye bye.